Hi, Nick Colas from DataTrek here, and thanks very much for clicking on this video. The topic of the conversation today is the VIX and S&P 500 forward returns, and I want to start with just a couple of points to set the stage for the discussion. The first is the CBOE VIX index measures expected near-term price volatility for the S&P 500, which is kind of a mouthful, but what it really measures is fear. As a matter of fact, it's known as Wall Street's fear index. The higher it goes, the more fear there is in the market. Since the start of 1990, when the VIX was launched, it's averaged a daily close of 19.5, with a standard deviation around that mean of 7.8, which simply says that the VIX can be as low as 12 and not be all that unusual, or as high as 27 and not be that unusual. But when the VIX gets abnormally high, 1 to 4 standard deviations above the mean, it's usually, but not always, a buy signal. The next couple of slides I'll show you reflect how the S&P performs after the VIX sees these statistically high closes. Let's start with how the S&P performs after the VIX closes between 1 and 3 standard deviations above the mean. And I've broken that down into 3 tranches, starting at 27, which is 1 standard deviation, and ending at 51, which is coming up on 4 standard deviations. And what the chart shows you is how the S&P performs 1 week, 1 month, 3 months, 6 months, and 1 year later, and then also the win rates associated with those tranches. So win rates are simply what percentage of the time the S&P was up over that next week, month, and so forth. And what you can see is when the VIX is elevated between 27 and 35, your forward returns are usually pretty good. The win rates aren't great over 1 week, which means the volatility can persist, but the average forward return is 0.5%. As you go out longer and longer, 1 month, 3 months, the returns get better. 1.8, 5.2, and by a year later, the VIX, the S&P, is 13.2% higher on average with a win rate of 77%. So not bad. But as you get to higher VIX levels, like 35 to 43, which don't happen as often, the returns are better. The win rates are better after 1 week. The returns are better, 1.1 and 66%. Then they get even better as you go on through time. 3% over 1 month, 8% over 3 months, 15 over 6, and 26 over 1 year. And you can see those returns are on average better than when the VIX is a little bit lower and the win rates are higher. So it says when there's elevated risk in the market, you do pretty well by buying those levels, buying the S&P when the VIX hits those unusually high levels. So far so good. More risk, more future return, that all makes sense. Where it begins to break down is when we get to VIX closes between 43 and 51. Because there you can see, and I've highlighted this in red, the 1 week forward returns are lower than 2 to 3 standard deviations. The win rates are lower. The same goes for 1 month later. Barely 50% win rate, and returns are lower than when the VIX is lower. And then out through 3 months, the win rates are lower as well. Now, when you get out to 1 year, the averages improve. So the returns are higher after 6 months. They're higher after 1 year than under the conditions of a lower VIX close, and the win rates are much better. So near-term volatility does seem to take a real bite out of nearer-term returns. Volatility kind of sticks around, it persists, and that causes further pressure on the market and valuations. The real kicker, though, is this next slide, which shows you what happens when the VIX closes over 4 standard deviations above the mean, so 51 or higher. That's happened almost as many times as the 3 to 4 standard deviation close level, but the returns are really not great. The forward returns are negative after 1 week, which is unusual, and they're actually below the returns 1 month later versus 2 to 3 standard deviations and so forth. After 3 months, you're at really bad numbers. You're talking about 34% win rate. So on average, the S&P is not higher after 3 months when the VIX closes at 51 or above, and the returns are negative and the win rate's very bad. After 6 months, it gets a little better, 10%, not bad, not as good as some of the other numbers with lower VIX closes, but okay. Now, after 1 year, it's pretty good, 32% return on average and a 99% win rate. But the big takeaway here is volatility isn't always a buy signal. It is, under some conditions, modestly higher VIX, but when the VIX gets to 51 or above, you really got to watch out, because forward returns are not great for several months after those kind of volatility levels. This matters for a couple of reasons, but the biggest one is the VIX closed at 52.3 on April 8th. That puts us definitely in that danger zone that I showed you in the prior slide for poor returns over the next 3 months, 34% win rate, negative return on average. But, and this is very important, in every prior instance, 2008, 2009, and 2020, when the VIX saw more than one +4 standard deviation close. We've only had one so far, so maybe this is an exception. The S&P was up 8% in the week following April 8th. That's much better than the average 4 standard deviation 1 week return of negative 0.2%. So another sign, maybe this is okay. And as of Monday, yesterday, we're filming this today on Tuesday, May 6th, but as of the close on May 5th, the S&P was up 12.9% from the April 8th lows, much, much better than that average 1 month return of 2.1%. So the bottom line here is we've thus far avoided what I call the curse of the super high VIX, because with a single observation, didn't have a whole string of them, and not part of a pattern of structurally higher volatility, which tends to really erode valuations and erode returns, as I've shown you on the prior 2 slides. The takeaways, I think, are probably 3. The first is answering the question, was April 8th the lows for the year? And the VIX says very possibly. That was a genuine panic level, and often a near-term bottom if no other shocks arise. The second is why? Why did this happen? The VIX declined and stock prices went up because President Trump and his administration knows the curse of the super high VIX, and particularly Secretaries Bessent and Lutnick understand the global financial system is simply not set up for persistent asset price volatility. It can't sustain it for very long. Things begin to break very quickly, and obviously the administration does not want that. More importantly, and I think this is really critical, the market understands and knows it now has the final say on trade and economic policy. The American economy is really levered to stock prices. A lot of people own stocks, either individually or in their retirement accounts or in pensions or other areas. And that's more important to the U.S. economy than a lot of other developed and emerging and market economies. The U.S. is kind of uniquely financialized and levered to financial assets at a consumer and business level. The bottom line here is we can't have another 51 VIX close for at least a couple of months. Volatility really kills investor confidence and valuations. And so we return to higher volatility, then we're going to see lower PE multiples, we're going to see lower valuations, and stock prices will decline. But if what we've learned so far in the year holds true for the rest of the year, namely that any incremental volatility will be met by policy responses, then we have a good shot, I think, of showing, if not double-digit returns for the year in total, then at least solidly higher from here. So with that, thank you so much for taking the time to watch this video. If you liked it, please hit like and subscribe. And be sure to check out DataTrekResearch.com to sign up for a 2-week free trial to see the kind of work we do for our clients, which this video is really just a small part of our work. So once again, thank you very much and have a great day.